Is the retail real estate market in North America witnessing a transformative shift? Welcome to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. Let's get right to it. In a massive move that could reshape the retail landscape, RCG Ventures has finalized a $1.8 billion acquisition of a multi-tenant retail portfolio from Global Net Lease, Inc. This transformative deal encompasses 99 properties across 28 states, totaling over 14 million square feet. With this acquisition, RCG Ventures more than doubles its retail portfolio to over 130 properties nationwide. The acquisition was supported by major institutional partners, including Ares Management and Koch Real Estate Investments, showcasing significant confidence in the multi-tenant retail sector. Truist Securities and KeyBank Institutional Real Estate provided the necessary financing, while McGuire Woods LLP, King & Spalding LLP, and Gibson Avenue Capital served as advisors on the transaction. Since its inception in 2003, RCG Ventures has deployed approximately $3.4 billion across 282 properties, representing 36.2 million square feet in 34 states. This acquisition aligns with RCG's strategy of focusing on shopping centers anchored by national retailers in high-growth markets. For Global Net Lease, this sale marks a significant reshaping of its asset base, potentially allowing the Real Estate Investment Trust to redeploy capital toward other strategic priorities or reduce leverage. This transaction highlights the ongoing strategic shifts within the retail real estate sector and the continued institutional investor confidence in multi-tenant retail properties. The Gulf Cooperation Council commercial real estate market is poised for significant growth over the next decade. According to the latest research publication by the iMark Group, the market size is expected to soar from $38.77 billion United States dollars in 2024 to a staggering $82.14 billion United States dollars by 2033. This growth reflects a compound annual growth rate of 8.20% from 2025 to 2033, highlighting the robust expansion anticipated in the region. Several factors are driving this impressive growth. Key among them are the economic diversification initiatives undertaken by Gulf Cooperation Council countries to reduce their reliance on oil. These efforts are leading to substantial investments in non-oil sectors such as tourism, entertainment, and technology. As a result, there is an increasing demand for commercial properties, including offices, retail spaces, and logistics hubs. For instance, Saudi Arabia's Vision 2030 has spurred investments in various sectors, creating a rising demand for modern commercial spaces in cities like Dubai and Riyadh. Rapid urbanization and the growth of the expatriate population in the Gulf Cooperation Council region are also contributing to the market's expansion. Cities such as Dubai and Doha are experiencing fast-paced growth, necessitating the development of more office buildings, retail centers, and industrial sites to accommodate the increasing population and business activities. The United Arab Emirates, with its sizable expatriate community, sees over 60% of its population comprising expatriates, driving the demand for flexible workspaces and retail spaces. This trend is mirrored in areas like Dubai's Business Bay, which continues to see a rise in office buildings catering to multinational companies. Government support and favorable foreign investment policies are further bolstering the commercial real estate market in the Gulf Cooperation Council. Countries like the United Arab Emirates and Bahrain have introduced long-term residency visas and allowed 100% foreign ownership, attracting global investors and businesses. Dubai's free zones, such as the Dubai International Financial Center, provide tax breaks, enhancing the demand for high-end office spaces. Government-funded projects, including Qatar's Lusail City, are creating opportunities for business growth and boosting investor confidence in the region. The rise of flexible workspaces and co-working spaces is a notable trend within the Gulf Cooperation Council commercial real estate market. This trend is driven by the increasing adoption of hybrid work models, with businesses, particularly startups and small to medium-sized enterprises, opting for cost-effective and scalable office solutions. In Dubai, co-working spaces like WeWork and Regus are expanding rapidly, catering to both entrepreneurs and large corporations. Similarly, Riyadh's co-working spaces are growing in response to Saudi Arabia's focus on innovation under Vision 2030. Sustainability and green building practices are becoming increasingly important in the Gulf Cooperation Council commercial real estate market. Developers are embracing eco-friendly designs, incorporating energy-efficient systems and solar panels to meet green building standards. Projects like Masdar City in Abu Dhabi feature eco-friendly office buildings that are leadership in energy and environmental design certified, appealing to environmentally conscious tenants. Saudi Arabia's NEOM project also emphasizes green construction, aligning with global environmental, social, and governance goals. Mixed-use developments are gaining popularity in the Gulf Cooperation Council region, blending commercial, residential, and recreational spaces to create vibrant, self-sustaining communities. These developments appeal to both businesses and residents, making efficient use of land and supporting urban growth. Dubai's downtown area, which includes the iconic Burj Khalifa, exemplifies this trend by integrating offices, shops, and hotels. Similarly, Bahrain's Marasi Al Bahrain offers a mix of retail, office, and residential units, showcasing the appeal and practicality of mixed-use spaces. In recent news, Frito-Lay has completed the sale of its Orlando properties for a total of $11 million. This transaction involves two properties located in the bustling industrial sector of Orlando, Florida, and signifies a strategic move by Frito-Lay to optimize its real estate holdings. The buyer, a private investment group, has not disclosed their specific plans for the properties, but the acquisition points to the ongoing interest and investment in industrial real estate within the region. Orlando's industrial real estate market has been experiencing steady growth, driven by a combination of factors including its strategic location, robust infrastructure, and the surge in e-commerce activities. The area's connectivity to major highways and ports makes it an attractive hub for logistics and distribution operations, drawing significant interest from investors and companies alike. Comparatively, in the Kitchener-Waterloo, London, and Cambridge areas of Ontario, the industrial real estate market is also seeing positive momentum. The region's proximity to major urban centers and its strong manufacturing base continue to attract investment in industrial properties. This trend is supported by the increasing demand for warehousing and distribution spaces, fueled by the growth of e-commerce and the need for efficient supply chain solutions. While the American market, such as Orlando, benefits from its geographic advantages and infrastructure, the Ontario market leverages its manufacturing strengths and strategic location within Canada. Both regions reflect a broader trend of rising interest in industrial real estate, as businesses seek to optimize their logistics operations and meet the growing consumer demand for timely deliveries. Singapore is anticipated to see a significant influx of retail space over the next few years. According to estimates from Savills, the city-state's pipeline supply remains steady at approximately 597,000 square feet of retail space net leasable area this year, compared to 679,000 square feet completed in the previous year. By 2028, major developments are expected to bring over 1.2 million square feet of new retail space net leasable area to the market, notably with the expansion of Marina Bay Sands. This anticipated supply translates to an average of 659,000 square feet net leasable area per annum from 2025 to 2029. This figure surpasses the 5-year historical completion of 445,000 square feet net leasable area per annum from 2020 to 2024. Despite this upcoming wave, the limited pipeline supply projected for the next 2 years, less than 400,000 square feet net leasable area per annum, could alleviate some pressure on retail occupancy and rents in the short term. In the domestic commercial real estate market, fierce competition between domestic and foreign big players is expected in the second half of this year for sales in the Trillion One unit. According to the investment bank industry, bidding for the sale of Pangyo Tech One Tower in Seongnam City, Gyeonggi Province, will take place on the 1st of next month, marking the beginning of the second half of the year. CBRE Korea and Cushman & Wakefield Korea will be in charge of the sale. Pangyo Tech One Tower is an asset held by Mirai Asset Management under Mirai Asset Maps, General Private Real Estate Investment Trust No. 62. The sale price is expected to reach 1.8 trillion won, making it a significant player in the commercial office market this year. Pangyo Tech One Tower is located at 534 Baekhyundong, Bundangu, Seongnam, with a total floor area of 197,236 square meters. It is the third largest office business facility supplied in major domestic business areas within the past decade. In the market, KakaoBank and the Singapore Investment Authority, a foreign investment company, are mentioned as leading buyers of Pangyo Tech One Tower. KakaoBank, an internet-only bank, currently uses Pangyo Tech One Tower as its headquarters building. The industry widely expects that KakaoBank will use Pangyo Tech One Tower as its base for global expansion. An investment bank industry official mentioned that KakaoBank is independently considering participating in the bidding without joining a separate financial investor. It is also understood that the Singapore Investment Authority is seeking to acquire Pangyo Tech One Tower. The Singapore Investment Authority acquired 45.08% of Pangyo Tech One Tower's beneficiary securities from Naver in 2023 and is looking for a financial investor to acquire the remaining stake held by Mirai Asset Securities and others. Mirai Asset Management is said to be hoping to sell Pangyo Tech One Tower at around 30 million won per 3.3 square meters. The sale of Pangyo Tech One Tower and other trillion won offices is expected to begin in earnest from the second half of this year. Signature Tower in Yeonggu, Seoul, where Aegis Asset Management is pushing to sell, plans to bid around the middle of next month. This trend highlights the vibrant activity and competition in the domestic commercial real estate market between domestic and international investors. Thank you for listening to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. See you on the next one.